afternoon, everyone. My name is Pamela Hastings, and welcome to another Barometer Readings webcast on this beautiful March afternoon as we continue to march into the spring. Joining me today, as always, is David Burrows, our Chief Investment Strategist and President here at Barometer Capital Management. And on today's webcast, we will be pleased to provide you a pretty in-depth macro overview of what's been happening in the markets. Certainly, there's been a lot of noise recently amongst some of the U.S. regional banks. David will be speaking to that, as well addressing any questions that you have at the tail end of the conversation. So please don't be shy. Email me at phastings@barometercapital.ca, or you can hit us up on the Q&A or the chat via Zoom. So with that, I should mention my email is phastings@barometercapital.ca. And with that, I turn the conversation over to our one and only David Burrows. Good afternoon, David. Lots of action today in the markets.
Lots to talk about over the course of the past week, Pam. So thanks very much for hosting today, and thanks everybody for joining us. It has been a busy week. It's been a busy month. Lots of cross currents, lots of things going on. As we talk about, markets are a process, not a moment in time. But we have to always go through the work, look through our lenses, and make the best decisions that we can make given the information that we have. And I often say that it is more about how the markets react to news than the news itself. And then you always have to look through that same lens and say, does the portfolio match up with what's going on? If not, what adjustments do we need to make? So, as always, I want to start sort of from the top and remembering that everybody has a different objective. Every manager is trying to do a different thing. To be clear, in our world, we think we have three basic jobs to do. People pay us a fee, so our number one job is to try to find a way to identify the more constructive parts of the market to focus in. We don't need to be everywhere. We need to be focused in assets that have a tailwind, where something's changing for the better that can support higher prices and higher valuations. And that might be very specific sectors. It might be very specific themes. It might be different geographic regions. It may be different asset classes at different points in time. But the one thing that we don't think is our job is to act just like the index. And so with that, we kind of look through our lenses to try to identify where that market leadership is. We're always looking for change, signs that old leadership is receding, new leadership is stepping forward, so that we can transition our portfolios to keep them in tune with what's going on. And then there's those times when nothing's working or big parts of the market are not working. And in those cases, we need to be able to play some defense. Because I don't think that if the market goes down 25 or 30%, we can afford to sit through that, just hoping for the best. So our job is to try and moderate downside, and then to try and take advantage of things when they're more constructive. So it is a very tactical approach. It's the lens that we look through. It's not for everybody, but the net of it is it's a step-by-step process. So just to start off from the top, as we always do, from an equity perspective, we continue to think we're in a constructive long-term structural bull market that started in 2013. We've stayed above this rising 200-week moving average since then. Certainly have been going through a corrective period in markets. Over the last 15 months, the maximum negative drawdown was 27%. That's when we touched the 200-week moving average in October of this past year. You can see that we have been stepping our way since then over a period of months, basically with some higher highs and higher lows. But it's not a straight up move. And structural bull markets are great because they bring long-term returns. It's always tough when you go through one of these corrective periods because the near-term 12-month period has an inordinate impact on your 3-year return or your 5-year return. The good news is when you come out of these periods and you have a 2 or a 3-year run in between, they also have an inordinate impact on your 3 or your 5-year number. So, that's why it's important not to just say we're going to throw in the towel and go to the sidelines. If we worry that we might break the long-term trend, you got to see it happen, because certainly if it does, then you could be in for a long drawn out process of advances and declines in the market or structural bear market. And at this point, we just don't believe that that's where we are. First of all, because this structural bull market that started in 2013 has not been particularly long. It's actually would be about the shortest structural bull market that I can point to. Second, the total return over the period has not been particularly high. You compare that to what happened in the 80s and 90s, it's a very different picture. But both are pockmarked by these corrective periods. You know, I like to look back at what happened midway through the last structural bull market, the 1990-91 recession. And in that period, as most people know, there was some real damage in the financial services sector. Lots of banks disappeared. There was a bunch of damage in the real estate market. It felt like it went on a long time, 16 months. The worst point, it was down about 20.5%. It was midway through a bull market. And when we came out, we rallied from 1991 early on in the year through until 1994 before you got the next corrective period. So these are difficult times to go through. We always have to assess, you know, what is constructive, what isn't, where do we get good risk reward, and we have to be patient. You know, market time is a lot different than people time. In people time, these bear markets feel like they go on forever, but then they resolve. And once, for instance, in the case of 1990-91, a tightening cycle is over, markets take off and they can become very, very constructive very quickly. From a fixed income perspective, we've been of the view after 40 years of falling rates, we've seen a generational reversal in yields. We've entered a period of rising rates. I don't think anybody would argue that at this point. When we first talked about it, I think people thought that that was not the case. But we do believe we're in a period more like the 1950s and 60s, where inflation slowly picked up. It was in fits and starts. Rates worked their way higher. Stock market had a pretty wonderful period and went up 15% a year with some corrections along the way. But certainly the place to be in that period, in that reflationary period, was equities. And this was a bear market in bonds. And in fact, from 1951 to 1966, interest rates went higher through the period. Bonds gave an inflation-adjusted 0% rate of return. Now, they may not have had much volatility, but nobody wants a 15-year period with a 0% rate of return. They'd much rather have a return from an asset that's better suited to a more inflationary period, which, of course, equities are. When we look at the 10-year Treasury note, yields were falling from 1981 to 2020. They reversed that. They broke out. They've consolidated over a period of time since then. And when we look at the long end of the US bond market, the TLT ETF, you know, it's been a pretty difficult place to be. It's going back to April of 2020. As it is right now, we remain below the falling 50-day moving average, below the 200-day moving average, 200-day moving average. And bonds have been not such a good place to be in the long end. When we look at commodities, commodities reversed a bear market that was in place from 2008 through 2021. We had a wonderful rally over the last number of months. They've consolidated over the last 4 months as markets have been, you know, sloppy-ish. They've basically been trading sideways. It's the only asset class that was positive in 2022 because it's a more inflationary asset. You know, when we continue to see data that means that inflation is a little bit more sticky than I think people had hoped. If we look at commodities versus the S&P, one asset class, in other words, versus the other, after a long period of underperformance, they broke out. And so commodities have to be considered a little bit more attractive than equities. So we think equities long-term structurally positive. Commodities have become long-term structurally positive, both well suited to an inflationary environment, and the asset that is poorly associated with rising rates, bonds, they're in a bear market, and it's enticing to go get a yield when we've had uneven markets. But if we got a 0% inflation-adjusted return over 10 years, I think that would not be an overly attractive place to be. So maybe for short periods of time and short duration bonds or short maturity bonds as a place to sit out some turbulence, that's fine, but probably not a long-term investment asset in the near term. Last week, we talked about the US dollar, and we've talked about it quite a lot over the last few weeks. after a run up all the way through the bear market of 2022. This was people looking for safety, also probably people looking for higher yields as the Fed was on a rate hike cycle, rolled over in November and broke that long-term trend. That was like a fever breaking. And certainly the US dollar versus the pound and the euro and the yen backed off. As of last week, it had rallied back and was sort of testing the area that it broke down from in December and testing underneath the 200-day moving average. So to be clear, when you're below the 200-day moving average, you're in a downtrend. We certainly were testing. And with that, stocks were pulling back a little. We look at it today, that test looks to have failed and the US dollar's rolled back over. So US dollar now backing off again. We see a lot of the momentum indicators reversing back down again. That's ultimately probably means two things. One, we may be getting in the late stages of a risk correction, a risk asset correction. And the second is that markets are believing less and less that in the short term, rates are going a lot higher. If we thought there was a major yield advantage to be in US dollars as opposed to, say, euros or yen, then you would see money flow into the US dollar. Or if we thought there was a real problem, then money might flow into the US dollar as a safe haven asset. Neither of those things are happening over the last few days, despite lots of bumpiness in financial services. So we got CPI data today. Core goods price growth was flat month over month in February. So this is a picture that has been improving. What do we worry about, or what does the market worry about, is that core services inflation accelerated to 0.6 month over month. So that's the strongest reading in services since September of 22. Now, big part of services is shelter, but if we exclude shelter, core services still was up 0.4 month over month. In other words, the services inflation continues to be kind of sticky, which puts the Fed in a difficult spot. They're trying to push CPI inflation back lower using interest rates and monetary policy to do it. At the same time, that same monetary policy is causing problems for some parts of the economy. If we look at CPI core goods, X used trucks and cars, which have been coming down in price, again, it's at about a 4-month high. So there continues to be fairly sticky inflation, which is a case that we've made. We want to own more reflationary assets, things that can put their prices up tomorrow if the demand is there, and that's something that is having an impact. So we look at it through our lens. We use our top-down tools to try to identify specific neighborhoods to focus in. We're looking for areas of the market that are showing expanding breadth, meaning more and more securities participating as time goes by. And then we use our bottom-up tools to try to identify very specific securities that we would use to express our view. So for instance, if we're looking at financials, we're looking for the best one or the best few, those that are good getting better, those that are outperforming their peers financially and from a price perspective, where we can find securities that meet our business tests in areas of the market that are showing net improvement in breadth. Well, then we consider putting on new positions, and our portfolio is a combination of those two things, because 70% of return comes from getting the right neighborhood, 30% of the return comes from finding specific securities to express your view. The third piece, and this turns out from time to time to be very important, selling discipline is the third piece of our process. We use stop losses on our positions. It means sometimes we sell things that we really don't want to sell, but they're just not acting the right way. It's possible there's something out there that we don't know that's finding its way into the market. And certainly, I think people wished they were using stop losses on some securities over the past few weeks, specifically some of the regional banks. So we can talk a little bit about that as we go. Ideally, from a top-down perspective, we're trying to find parts of the market where over time the participation in strength is expanding, meaning more and more securities participating to the upside. We consider that to be constructive. What we consider to be less than constructive is when over time fewer and fewer securities perform well. It means breadth is deteriorating or getting more narrow. It may be that the leaders continue on, but the weaklings have fallen away. When we see that taking place, whether it's for a whole asset class or a specific country, say for equities, or a specific sector or theme, it means we don't put any new money to work and we tighten up our stop losses. And so we'll talk again a little bit about that today. So breadth is something that we spend time trying to understand because it tells us the state of health underneath the surface, what's actually happening underneath the surface of the index. So last week we highlighted that our breadth model, or the percentage of stocks in uptrends for the US, had started to weaken, and that we had seen some weakness in some of our short-term indicators. Canada had remained more resilient, and globally stocks remained more resilient. So let's just flip one to the other. That's last week. This is this week. You can see that percent of stocks in the US in uptrends deteriorated further. Last week, we said we're not putting on any new positions. We've got some cash. We've got some short-term bonds, and we'll continue to follow our stops. Globally, the percent of stocks in uptrend reversed lower also. That means we no longer put on any global positions. Our short-term indicators have moved to the left, meaning, for instance, that the percent of stocks with positive weekly momentum has been falling. Doesn't mean that the stock prices are going down. It means that the percentage of stocks working their way higher or upward trajectory has become more narrow. Now, last week we highlighted that the percent of stocks with momentum was falling and getting down to an oversold level, which is where we sit today. If we go back over the last several years, when this gets down below 20%, we start to look for a reversal higher because it means we're getting closer to the end of a correction. We'll see, but we're not putting new positions on while this is the case. If we look at the S&P, we made a low in June. We made a second low in October. At that point, only 12% of companies were in uptrends. We made a higher low in December when the NASDAQ made a lower low, so the S&P was outperforming. And again, we've pulled back now over the last few weeks. We rallied sharply into February, got extended away from the moving averages, and now we've pulled back. We pulled right back to this long-term trend line. We briefly dipped below it yesterday. We've closed above it today. We'll see. But this is an uptrend, a new uptrend that's under pressure. It doesn't mean every part of the market is under pressure, but it means something's going on out there, and we have to stay on top of it. So let's talk leadership for a moment. In October, if we take all the various sectors that we track from a breadth perspective, most sectors had very small percentages of stocks in uptrends, meaning it was a very narrow market. Now, we know that was an important market low. In February, after rallying for 3 months, the percent of stocks in uptrends had moved to the right, meaning moved higher. The broadest groups were the most economically sensitive: steel and builders and financials and insurance and industrials and energy. If we fast forward to last week, we started to see some sectors break down from a breadth perspective. When we go from sectors being in large caps to small caps, it means that breadth has started to deteriorate. So the average sector as of last week had 46% of stocks in uptrends. The week before that was 53%. So the average sector had 7% of their stocks reverse lower in price. Let's look at this week. We've moved down further. Number of the strongest sectors, which held up the longest, reversed over the last couple of days. So again, we're testing. We talked about the fact that bottoming is a process that we go through. It takes time. We've pointed out earlier on that 1990-91 took 16 months. We're 15 months in now. And we certainly have had the magnitude that would be typical coming from a Fed tightening cycle. And in 1990-91, there was things that broke. Now, this is the XLF. So that's the Financial Services SPDR ETF. This is made up of insurance companies, banks, and diversified financials. As of last week, had been working its way higher, making higher lows and higher highs. Relative strength had been improving since July, but we saw some deterioration this week, something happening under the surface. So what in particular? Well, really the big problem was the regional banks. These are smaller banks that are in very specific geographic regions, in some cases with very specific types of clients. And you can see there was a very sharp move down over the last 6 days, today up a little. Well, this is the biggest culprit. This is this SVB Financial, otherwise known as Silicon Valley Bancorp. Now, Silicon Valley Bancorp has been a fabulously successful bank over time. They got into the tech space and venture capital in particular, and they wound up being the banker to the technology sector in the US, in California. But you can see its fortunes were tied to tech. When tech rolled over as a sector in December of 2021, it started to back off. The relative performance versus the market was weakening steadily. This is where stop losses are important. In this case, if we had owned this bank, and we owned it years ago, this is where you'd have to come out. You're breaking the long-term moving averages, and the long-term moving averages roll over. And then it just continued to weaken and weaken and weaken and weaken. When tech bounced at the end of December, it rallied with tech, but never got above the declining long-term moving averages. We talk about wanting to own the best security in a group. We want to own the ones that are good, getting better, improving their competitive situation. This is not one that would qualify. In fact, I got asked about this the other day on BNN. I said, look, you're tying yourself to the tech sector. This is before this stuff happened. I think you wouldn't want to get involved here. Now, there's something to be said for when something's down a lot, it doesn't mean it can't go down a lot more. So in one day, it traded from $260 to $106, and that was the end. It halted. And we know that since then has gone to zero. It's why stop losses are important. From time to time, you're going to get stopped out of something, and it costs you some money, but it might save you way more money. Now, what is it that made this bank particularly risky? If we take a look at a bunch of banks and look at the loan to deposit ratios. So first of all, where do they get their deposits from? So we're looking on the left here at where the source of the deposits. So JP Morgan, 50% of their deposits came from retail investors, individuals. No one client being so important. We look at the case of Silicon Valley Bancorp. Only 9% of their deposits came from individuals. 93% of their deposits came from one industry, and that's technology. And then the next question is loans plus securities as a percent of their deposits. So in other words, they had their capital stretched. And of course, what happened? Well, the deposits started to decline. With a tech wreck comes less tech financing. And with less tech financing, it means that the cash that some of these early stage companies had in the bank were being used to pay payrolls and their burn rate. So between having a very specific type of depositor and a declining set of deposits, ultimately it put them at great risk. Let's look at JP Morgan, which is our largest bank weight as a firm, right? Very high percent of retail depositors and a very low rate of loans plus securities as a percent of deposits. It's the safe one. When we look at the types of deposits and assets that they held, Silicon Valley Bancorp had over 50% of their assets as assets they put aside and said, we're going to hold these to maturity. And in a lot of cases, these were treasury bonds that they had. And we know that the treasury bonds have been through a major bear market. When they got to a point where they needed to sell some of those assets because the deposit base was going down, they had to start realizing losses. And a combination of those two things put them over the edge. Very different picture than, say, a JP Morgan. So let's look at some of our bank holdings. As a firm, we have about 10% of our assets in banks. So we had, as of last week, 25% in financial services, but we mentioned banks are not the biggest part of that. A lot of it is insurance. Our big banks, Royal Bank would be our second biggest weight behind JP Morgan. rising relative strength versus the S&P, and that has not broken. So a very different looking picture. And this is the same picture. Now, what makes Canadian banks different than US banks? Well, this is the deposits in US banks. So large US banks over the last number of quarters have seen falling deposits. In the Canadian marketplace, we're seeing steadily rising deposits. Canadian banks are very large on a relative basis versus most of certainly the regional banks. They have very broad, diversified depositor bases. Geographically, they're diversified across the country, and the contributions from different industries are very, very diversified. So JP Morgan and RBC would be our two biggest weights. And then we do have some exposure to CIBC, and we do have some exposure to State Street, which is a custody bank, which basically custodies securities on behalf of funds and investors. Both of those are pretty defensible business models. So of our financials weight, 55% would be banks, and the lion's share of that, the highest quality banks you can find. Let's talk industrials. Industrials have been relatively outperforming the market since the market bottomed in June. That continues to be the case. They pulled back a little bit over the last week, not a big deal. Defense stocks acted quite well. Machinery stocks continue to act well. Materials remain above the moving averages. We've seen a series of higher lows. They pulled back a little over the last week, but sitting above the 200-day moving average. And one of the interesting areas that has been developing over the last week is the precious metals market. This is a long-term picture of the price of gold. We put this up from time to time over the last few months, saying this is quite constructive and ultimately looks as though it's getting ready to move substantially higher. We're trading very close to the high for the last 3 years. If we get up and out of this channel, technically, it's highly likely it has a pretty substantial move higher. And when the US dollar started to back off earlier in the week, gold started to work its way higher. If we compare gold versus the S&P, one asset class versus the other, it tends to move in long periods. In 2001, when stocks rolled over, gold outperformed from 2001 through 2011. It underperformed while the stock market was rallying sharply from 2011 through 2021, and gold has started to outperform again. So I don't want to ignore this as an asset class. I know it's an unpopular asset. It's one that people haven't made money in general over the last number of years. In our macro portfolio, as I think most people know, we have a fairly sizable weight as a defensive position. Energy. So this is the second area of the market that I think probably saw some change over the last couple of weeks. We've seen some relative weaker performance over the last few months. I think most people know we've taken our exposure down as a firm over that period. And then in the last 2 days, we broke the 200-day moving average. So this is something that we keep a very close eye on. This is the XLE ETF, which is made up of large cap energy producers. They pay great dividends, but certainly still depends on economic activity and the price of oil. This is the XEG, which is the Canadian Capped Energy Index. And it has been consolidating also over the last number of months. Now, there's not a lot of damage here, hasn't moved down a lot in price, certainly the oil producers, but in the last 2 days broke down out of this consolidation. So that probably means prices can move lower. So look, we're not about holding on at all costs. We do use stop losses when we have seen underperformance. We've reduced our weights, and in the last couple of days, reduced them further. So not an area that we've been adding to. It's been an area that we've been cutting back from, and we cut back more dramatically over the last couple of days as oil started to break down out of this consolidation range. So this is obviously concern about the impact of Fed tightening. It's obviously has to do with concern that the Fed higher rates are causing some damage in financial services, and what might that mean for the rest of the economy? That is true. It also, though, means that the Fed probably is getting very late in the tightening cycle, because as we know, when things start to get difficult or tenuous in specific big industries, it makes it harder and harder for them to tighten. So it's a double-edged sword. It means we could be close to the end of tightening, which would mean relief for certain industries, but it also means that it does put pressure on some of the economically sensitive groups. Let's look at things that have continued to work well. Home construction, surprisingly, continues to work its way higher. It's above the 50-day moving average and above a rising 200-day moving average. Things that aren't working. These are the same things that haven't been working for quite some time. High dividend paying common stocks. High dividend paying common stocks are most like fixed income. They tend not to have much growth. They tend to pay out a fairly high percent of their earnings. They're something that looks less attractive as yields go higher. And these are industries like utilities, consumer staples, and real estate investment trusts. This is a ICF real estate investment trust ETF making relative strength new lows. This is the consumer staples ETF, which has been backing off, since the beginning of beginning of December. These defensive assets would tend to do well if the economy is slowing down. And there's the healthcare ETF XLV, made up of pharmaceutical companies, made up of biotech companies, made up of healthcare equipment companies. So as always, we have to put this together and say, what does it mean in our portfolios? As we sit today, you can see that financials weight came down over the course of the week as a firm. But we've talked about the fact that banks have not been the major part of our exposure in financials, but they're still important. The yields associated with the banks that we own, we're comfortable with. The risks of the banks that we own are very, very defensive. And we think that these are good assets to hold through the course of a reflationary period. But you can see in our weightings over the last few weeks, short-term government bonds have become a bigger weight. As of a week ago, this number was at about 17%. It's 20.5% today. These are basically 1 year, 6 month to 1 year bonds. If we add into that 5.6% cash and 5% corporates, it means that the average one of our portfolios has about 30% in cash and short-term fixed income. That's as a result of being stopped out of some positions and not putting new positions on while we're in a sloppy market. Industrials have come down about 5% from 18% to 13%. Technology is still only about a third of the market weight. And the ones that we hold continue to act quite well. Energy, which was a larger weight, is about 7%, and that's about where we were a month ago. It would be a little bit lower than that today, but the net of it is, depending on portfolios, energy's come down a lot. Materials, it's about 2 times the weight of the S&P. These continue to act pretty well. They are economically sensitive. They're not a big weight, but it's a group that's outperforming the S&P. Things that we don't own. Utilities are underperforming, we have very little exposure. Real estate, underperforming, very little exposure. Healthcare, underperforming, very little exposure. Communication services, which includes telecom, high dividend payers, very little exposure. And consumer, very little exposure, just a fraction of the index exposure, and consumer staples would be the same. So common characteristics in the portfolios. We have reflationary assets, financials, industrials, and some materials. We have some short-term deposits and fixed income, 25 to 30% per portfolio. And we have very low exposure to things that act like fixed income, long-term fixed income, real estate, healthcare, communication services, utilities, and staples. Pretty defensive portfolio, ready to put money to work. Should we see our short-term indicators start to turn higher again? My guess is it won't be too long. But the net of it is we're not going to guess when that is. We're going to wait and see that start to take place. Outside of North America, last week we made the case for the fact that we've seen the beginning of a period where securities outside of North America outside of the US are acting better than US-based securities. What we've talked over the course of the year, a big part of our exposure in our portfolios are Canadian equities, which have been outperforming US equities. And over the past few weeks, we've talked about the fact that Europe is acting better. European ETF trading above the 50-day moving average and the 200-day moving average, and against a pretty sloppy market, hanging in like a champ. Mexico acting well. And we talked about Japan, and we've talked about Asia Pacific acting better. So it's a pick your spots market. We continue to be above a rising 200-week moving average. I know this is frustrating to read the negative news. And we're thankful that we use our stop losses to protect us against big declines. And should things get worse, we'll continue to get more defensive. But we're comfortable with our holdings as we sit right now with no major exposure to any of the broken parts of the market. So with that, happy, Pamela, to answer any questions that people might have.
Hi, David. Yes, of course. We've actually got quite a few questions here. So Christopher has a question here. He's asking, David, does the level of indebtedness of our society pose a threat to a structural rising rates period like the 50s and 60s? Is something going to break and cause a sudden shock to the stock market?
Well, certainly we have to be watching for that. The financials have come under some pressure. It's really probably the most vulnerable parts, the parts that, we talk about, very specifically focused on one industry, and it happens to be the industry that's been most under pressure. In general, asset quality has been good and loan losses have been low. We'll watch to see if that develops. My guess is that the Fed probably is pretty much done taking away the punch bowl. Right? There's not a lot of excess liquidity. Money supply has been shrinking. That's what they've been trying to do. So my guess is we will have a more cautious Fed going forward. The market starts to sense that. My guess is it continues to act quite well. Employment has remained very robust, and pricing in some of the areas that we're focused on has remained pretty robust. So that's quite remarkable given the fact that we've had the fastest, steepest tightening cycle in history. Our rates, short-term rates, are back to where they were before the financial crisis. And we've been through 13 years of financial easing. I think that we have to watch the groups. I don't want to have a lot of exposure to the consumer, and we don't have a lot of exposure there. We don't want to have exposure to things that get hurt by higher rates. So the high dividend payers look less attractive when we have higher bond yields. As attractive as it might seem to go out and get a higher return than we've been able to get in several years on longer term fixed income, we still see that inflation is a bit sticky in the economy. So, we have to watch all of the different pockets. And I think it's important to remember that an investment portfolio is not the economy. Our focus is in specific areas that are well suited to the current environment. So I watch the Canadian marketplace. Certainly there's more consumer debt in Canada than there is in the US, because we didn't have the same kind of correction we saw in the 2008-9 financial crisis in real estate as we saw in the US. So we watch that. But we do at the same time think that there's a lot of fiscal stimulus coming and a lot of policy directed at bringing manufacturing back to North America. And so far, you see a lot of resilience there. So it's I think, about picking your spot.
Thanks, David. The next question is, how are you looking at playing gold? XGD, maybe Sprott's PHYS? How are you thinking about that?
Well, it's interesting. I was going to put up, see if I've got it here. Presentations. Yeah, so let me just share this quickly. So this is our global macro exposure. And so you can't really see percentage terms, but over 20% of our macro exposure is in precious metals. And, it's been that way for a while because we think the risk reward looks quite good there. And certainly it's been hanging in pretty well. That's a combination of about 50%, actual precious metals, PHYS, which is the physical gold ETF, which actually owns physical gold. And it's moved up from 1250 to 1470. Going back from October to now. It had a very good week this week. We own PSLV, which is the physical silver ETF. Both of those are about 5%. And then we have about 5% in gold producers using GDX, and we have about 5% in silver producers, SILJ. So that's sort of the way that we've done that. We have some individual securities like Franco-Nevada, which is a dividend payer royalty company. We have some mid-cap golds, things like AYA Gold. We have and a few smaller cap securities. So it's a mix. And I think that right now it's interesting with a weakening US dollar and a Fed that looks like it's probably less likely to tighten going forward, and bond yields coming off a little bit. That makes a more fertile ground for precious metals.
Thanks so much, Dave. Pivoting to technology, John, an investor with our firm, noticed that we haven't been hot on technology as of late, but we did add open text to our portfolios. Any rationale behind that?
Yeah, look, there are a few groups that certainly have been acting better. Now, can you see my screen? Is there a chart on the screen here?
Sure is, Dave. Thank you.
We have sort of more value-oriented tech. So in the case of open text, it's a 3% dividend yield. The dividend growth rate's 12%. It's had really nicely rising relative strength, is trading above the 50 and 200 day moving average. 50-day 200 and 150. We own some NVIDIA. NVDA. Again, acting much better than the group. Actually, it's better than 96% of companies in the S&P over the last 12 months. We own some Cisco, and Cisco is more of a value play. 3.2% dividend, growing its dividend high single digits. Again, trading above all the moving averages, and all of the moving averages have tipped higher. We have only about a third of the weight of the S&P in tech. And I like that because, I think we really have to pick our spots. The things that we really don't like are the unprofitable tech, the meme stocks, the things that were so hot during the pandemic. They've come down 70-80%. They are not likely to become leadership anytime soon in the market.
Thanks so much, David.
So the last thing I'll just say is probably the biggest weight that we have in tech overall is semis. And it is the group that probably is best suited to a reflationary environment where, as inventories get drawn down, they can put their prices up at a moment's notice.
Thanks, David. Final question for the power hour, as we like to call it. This one's on nat gas. Dave, any view? I know you don't like to forecast too far ahead, but do you have a view on where the price of nat gas might head?
Look,
silver ball to look
nat
through.
gas has been a very, very tricky place to be.
Yeah.
And again, thank goodness for stop losses. We got stopped out of all of our gas producers earlier on in the fall. The expectation was, of course, that nat gas would be strong because of what was going on in Eastern Europe. But the fact is that a bunch of the shale oil producers are producing more gas than oil as the wells mature. The Freeport LNG terminal being shut for so many months took away one source of offtake, and that was an issue. And then, most of Central and Eastern North America has had a pretty warm winter, and so demand has been probably lower and storage probably higher. So this is probably not the time of year to step up and buy these folks. We've had more oil related securities, and even that, I think, it may be with the Fed being as tight as they are, that hedge funds are trying to find ways to bet against the economy remaining strong, and so we've seen some weakness in energy prices there. So, look, when things are weak, don't try and pick a bottom. Let things develop. It would be very unlikely, for instance, to see nat gas bottom and V bottom and go straight higher again. It's going to take some time. So I think you got to give it a little bit of space.
Thanks so much, David. Well, that concludes the questions we've received this afternoon, and as always, a very fulsome conversation. Thank you, Dave. I'll leave you with the final word.
Yeah, folks, thanks very much for tuning in. I hope this stuff is useful. I wish we could say it's easy. It's not an easy market. Going through a Fed tightening cycle is filled with data coming that is supportive and then against, and bottoming is a process. But we know that as long as we stay sort of in a structural bull market for stocks, we likely have a 2 to 3 year period coming in front of us that can be, very, very fruitful. And my big fear is that people throw in the towel, having been frustrated by the market, frustrated by the news flow, war, higher rates. They're all things that we worry about. But, when things start to break down, we do get more defensive and we take on that responsibility. And I think as we go forward here, there's going to be lots of opportunity for us. So just got to take one step at a time, one foot in front of the other. And if you got questions, give us a call. Happy to jump on the phone. And if you're shy, we'll have a one-on-one conversation. Pam, thanks very much for hosting today. And thanks everybody for tuning in.
Thanks, David.